Welcome back to Indianomics. We have been discussing the Reserve Bank discussion paper, which asks the question whether we need a new dedicated bank for long-term financing. My guests now are Mr. B. Sriram, Managing Director, State Bank of India, Neeraj Gambhir, Managing Director, Fixed Income at Nomura, and Rashesh, Shah, the Chairman of Edelweiss Financial Services. Gentlemen, welcome. Mr. Sriram, I don't know if you could hear what Dr. Rangarajan said. His main thrust is that the jump to universal bank was probably premature, that a space is needed for long-term financing with a new institution. What is your sense? Do you think the universal bank model will not work for long-term infrastructure lending?
To my mind, actually, the concept has two broad issues to address. One is, of course, that the appraisal skills and the requirements of long-term funding, especially in the infra space, needs very, very specialized training and analytical skills. And that is where the long-term financial institutions probably would have brought in better expertise. Is one sector of thought which the commercial branches, or rather the universal banks, have not been able to do so. So that is one school of thought in that particular area. The other area is, of course, that these institutions have issues with financing costs or charges, both from the lender side and from the borrower side. Their resources are quite high cost, and that was one reason why a number of DFIs actually went into the universal banking mode, where they were getting access to a lot of low-cost deposits, and thereby making infrastructure funding and even corporate funding a little bit much cheaper than what it would have entailed. If you see the interest rates that happened those days for DFIs, they were pretty high.
Yes.
Even after the government support by way of credit enhancement or tax-free bonds and so on and so forth. But even after that, you would find that the cost of financing is pretty high.
Okay.
And also, if you add to that, there's hardly any income to the bank other than the transaction that happens, either in terms of the fund-based or non-fund-based limits that they do. If you talk about other areas where today the universal banks get incomes from corporates or from infra by way of selling cash management products, insurance, both general and life, and salary accounts, retail business, and so on and so forth. That all of that adds to the income from a particular relationship, thereby making a little bit the cost of the core funding becoming much cheaper than what it otherwise would entail. So these are two broad areas which I feel that needs to be discussed.
Neeraj, these are two different issues that Mr. Sriram is raising. You were there when ICICI got reverse merged into ICICI Bank. The first question is that is the universal bank at the moment unable to fund long-term needs? Should the answer lie in restricting long-term finance to only, say, 2 or 3 universal banks, maybe SBI, ICICI variety? Would that be the answer, or would it be an altogether new experiment with DFI?
So I think the historical perspective of merger of ICICI with ICICI Bank, or for that matter the 3 development institutions that we had at that point in time, the context was quite different. The context was that the banking sector was quite fragmented, and at that point in time there was a vast funding difference between where ICICI could raise funding versus where, let's say, State Bank of India could raise its liabilities. And in the context of domestic banks becoming more active in corporate lending, and not just in, let's say, working capital financing, but also in term financing. The financing cost of the development financial institutions was quite high, and they found it very hard to compete. So, that, to my mind, is a very, very important issue when you think about a long-term financing institution in the context of, Indian economy, where most of the liabilities of the banking system are actually pretty short-term. right? So where is the long-term liability going to come from? That was the issue then. That is the issue that probably is going to be discussed even now when we think about these long-term financing banks. To my mind, the concept of a specialized wholesale institution is a very interesting concept, and it needs to be thought about. It needs to be delved into further. But a copy paste of the earlier 1960s, 1980s DFI model into today's time is probably a wrong thing to do. I think what we need to think through is a model which is a hybrid model between an investment bank and a commercial bank, where a bank which is, let's say, a wholesale long-term financing bank is not only just doing a classical borrowing and lending transactions, but is also developing the market, the capital market along with it, by doing stuff like securitization of these assets, different forms of credit enhancement, raising financing through cross-border mechanisms. So the suite of products that this kind of a bank that needs to today deal with to effectively manage its liabilities and effectively manage its asset side risk is entirely different. And that's something that needs to be developed, and probably development of that suite of products in the context of a very universal bank is a little bit more difficult than in a specialized institution which is more dedicated towards capital markets, more dedicated towards cross-border activity, etc.
Yeah, wait, I think we are confusing issues both between commercial bank and long-term finance. Give me first a monosyllabic answer. Do you think that the current commercial bank cannot do long-term financing, or are you saying that some commercial banks cannot? Like, for instance, HDFC Bank has chosen not to, and RBL perhaps will choose not to. But some people like SBI and ICICI could continue to have the skills. So is the commercial bank, universal bank model wrong, or is it that some of them should do but some of them should not? Neeraj.
I think the universal bank model is not wrong. I don't think the commercial banks cannot do it, but I think that in every marketplace there is a need for specialized institutions for a particular activity, and that kind of a specialization is sometimes hard to develop in a more generic, universal commercial bank, and hence, otherwise you wouldn't have had investment banks in the first place, right? So the fact that you have these kind of institutions exist means that there is a scope, there is a place for more specialized institutions which understand some of the dynamics of these kind of financings and these kind of market activities a lot better than probably a generic commercial bank would understand. Now, that is not to say that State Bank of India and ICICI cannot do it. I'm sure they have the capability, but probably you can't have 26 or 40 of these banks doing the same thing.
Yeah, right? that was the limited point I was making. Okay, now let us assume that we have to try and work a long-term financial institution model. Rashesh, how would that institution become viable?
See, again, I think what RBI calls wholesale finance is actually looking at more corporate accounts and all, which will, I guess, have to have both the long-term assets and the short-term assets also. And I would think that a lot of these institutions will end up playing in the bond market, will also be part of the primary dealership and all. I think it is viable, and this is all part of RBI trying to make the Indian financial system more heterogeneous because currently it is very homogeneous. So I think that objective is obviously achievable. As we have already spoken, the key challenge is going to be on the liability front, and what we have seen with wholesale funded institutions having long-term sticky liability always going to be some kind of a challenge unless we have very robust bond markets. So I think the way this will work is most of the long-term banks or the wholesale banks will be aligned to the current universal banks, and it will be some kind of an alignment so that you can get the asset side expertise on one side but have the stability of the liability through your association with a universal bank.
See, if a long-term finance institution is looking only for bond market money, today its cost of finance has to be northwards of at least 7% or 7.5%. So, Mr. Sriram, what Rangarajan was saying was that you have to give some kind of government aid to this institution so that at least some of its money is cheap. Some foreign money, some SLR status or some tax-free bonds. You think that is the way out?
Partly, yes, there has to be something in it for these banks. You see, there is for these banks to become viable, to my mind, two broad reasons. One is that on a standalone basis, the cost of resources is going to be very important for these banks. And the second is, of course, that the competing, you're going to be anyway competing with the universal banks who are not going to give up this space.
Yeah.
And in that context, the pricing power of specifically the better rated corporates is going to again face a challenge there. So the point here is that on a standalone basis, if the cost of resources is going to be high, and I would imagine that without a credit enhancement or without any sort of, even today, if you see the cost of resources of an IFCI, for example, or an IAFCL, it still requires a lot of working to make to cost cheaper for the asset for the person who is going to take a loan. And to that extent, some sort of for a person who starts a bank and then tries to raise resources, the resources can come only from 2-3 sources. One is, of course, the public deposits, from the bonds, from maybe external commercial ECAs, or from member or sister banks which are there. Now all of them are surely going to take upwards of 8% in terms of resource, and if you add the CRR cost to it, it is definitely, and with the margins and the sort of risk that is being taken by these banks in the infrastructure lending, especially prior to COD. I think the viability aspects, as I said in the earlier, it's very important today that the financial costs, both for the person who is borrowing and for the person who is lending, have to be pretty good. And
therefore, government help will be needed.
There are problems in terms of project completion. Some sort of government need has, could be needed for such banks initially.
Okay, Neeraj, how would you design this institution in terms of liabilities?
I think there are two parts to liability cost. One is the direct cost that you pay to your lender, which is the bondholder or the depositor. The second is the regulatory overburden that comes onto this liability, right? For example, CRR, SLR, priority sector lending, these are all things that add to the cost of the cost of the liabilities. Now, is it possible for us to design an institution where we, given the fact that this institution is likely to be funded largely from bond market or funded largely from long-term sources, can you actually minimize the burden of let's say CRR and SLR on these banks? Can you completely do away with the need to do priority sector lending?
Then it will be viable.
Given the fact that infrastructure is not a big focus, I think that can take away something close to 50 to 75 basis points of cost. And also bear in mind that by design, these institutions are likely to be lightweight in terms of their physical infrastructure. They're not supposed to have thousands of branches all over the country. There will be few institutions, lesser number of people, lesser overhead in terms of manpower. So I think it's possible to come up with a financing structure where the cost of liabilities, it may not be as competitive as, let's say, State Bank of India's cost of financing is or cost of liabilities is, but it can be pretty reasonable. And also bear in mind that most of the infrastructure financing is not AAA rated. It's somewhere close to BBB minus. They are all project risk. So you need to charge for the project risk. So it's possible that you can design a liability base which is more suited towards infrastructure financing, more suited towards long-term financing, but then carries minimal amount of regulatory overhang in terms of cost.
Wasn't the old IDBI and ICICI also free of this level of CRR and SLR responsibilities? Rashesh, what's your sense? The costing only borrowing from the bond market will not work. What's your final winding up comments on how to make this work, and more importantly, won't this face concentration risk?
There will be obviously some innovation on both the asset side and the liability side. My understanding is that the wholesale banks will not be subjected to SLR, CRR and the priority sector. So in a way, they will have that small advantage of not being burdened with that. I think they will be able to borrow in Indian market, international markets, they will not be as highly geared as a bank. So I think because they will have a much higher chunk of equity, their overall cost of funds will be lower in the sense that NIM should be protected. I think the larger thing to make the business model viable will have to be work on the asset side, and I do believe that if these institutions are conceived as only project financing institutions, then it will be hard to make it work, because the asset quality, the inherent risk, and the fact that on that they will still compete with the existing universal banks will make it highly unviable. But I think if they do a lot of other things like structured credit, if they do some other M&A financing and other wholesale activities also, then they will have enough innovation possibilities on the asset side to make the yields really work for them, because they need to compete in a few areas that currently banks are not able to compete because of either capital market exposure or other reasons, and allow them to also provide another specialized form of financing for the corporates in India.
Fair point. Well, that certainly opens up other avenues of making money, but we are out of time. Gentlemen, we have set the ball rolling in terms of discussing how a long-term financing institutions might work. We will flesh out this topic in future editions of Indianomics. Thanks for watching this one.